Today, we will talk about earnings before interest, taxes, and amortization, EBITDA. Earnings before interest, taxes, and amortization is a measure of company profitability used by investors. It is helpful for comparing one company to another in the same line of business. In some cases, it can also provide a more accurate view of a business's value. EBITDA is a metric taken from the financial data collected and reported by a company for a reporting period. Some analysts and investors consider a company's EBITDA to be a more accurate representation of its actual earnings because it removes the taxes owed, the interest on company debt, and the effects of amortization from the equation. It also is viewed by some as an indicator of the efficiency of a company's operations. EBITDA is not used as commonly as EBITA, which adds depreciation to the calculation. Both EBITDA and EBITA are used by some analysts for gauging a company's operating profitability. However, some industries require significant investments in fixed assets, and in that case, EBITA is deemed a more appropriate measure of operating profitability. Earnings before interest and taxes, EBITDA, and EBITA are examples of commonly used non-GAAP financial measures. Many companies report GAAP earnings as well as non-GAAP earnings, which exclude one-time transactions. The rationale for reporting non-GAAP earnings is that substantial one-off costs can distort the true picture of a company's financial performance. To calculate a company's EBITDA, you must first determine the company's earnings before tax and then add any interest and amortization costs. The formula is, earnings before tax plus interest plus amortization equals EBITDA. Each of these is a measure of profitability used by analysts. EBITDA is the more commonly used measure, as it adds depreciation to the list of factors. If a company doesn't provide this metric, you can find it by looking at the firm's financial statements. A shortcut to calculating EBITDA is to start with operating profit, also called earnings before interest and taxes, then add back amortization. EBITDA is considered by some to be a reliable indicator of how efficient a company's operations are. Some analysts use it to gauge profitability, although doing so can be misleading because of the excluded expenses. Earnings before interest, taxes, and amortization is one way analysts measure a company's efficiency, profitability, and value. While it can be a useful tool, it isn't always an accurate reflection of a business's financial situation. Here are 4 key takeaways. 1. Earnings before interest, taxes, and amortization, EBITDA, removes the taxes owed, the interest on company debt, and the effects of amortization from the earnings equation. 2. This measure can provide a more accurate view of a company's value. 3. EBITDA may also allow for easier comparison of one company to another in the same industry. 4. EBITDA can be misleading as a valuation method because it excludes certain expenses from earnings. Hope this would help. Thanks for watching.